global market outlook, the income opportunity. A strong equity rebound since mid-May brightens the near-term outlook, but it is natural to question whether this is the start of sustained gains or just a bear market rally. Nevertheless, earning attractive yields from income strategies has become much easier. Multi-asset income strategies offer an attractive opportunity to earn yields, last seen at the peak of the 2020 sell-off. They are also a route to gain exposure to our preferred bond asset classes through a well-diversified allocation. Within equities, Asia ex-Japan offers an opportunity to diversify away from the US-centric recessions debate. Financial and energy sectors should benefit in the current macro environment. Gold remains an attractive diversifier, especially if the USD is close to peaking. Investment strategy and key themes. After the round trip, the scenarios. After a downbeat April, May offered investors some relief. Global equities staged a 7% rebound from mid-May to the end of the month, approximately where they started. Bonds delivered slightly higher total returns as yields took a turn lower, while gold lagged. May's relief rebound notwithstanding, the key question remains, is this simply a temporary bear market rally, or the start of more sustained gains? A combination of macroeconomics and market history could help offer some guidance. US history shows equity markets do well in non-recessionary years. Global equity market valuations have dipped, and yields have risen this year. This combination means long-term expected returns are starting to look more attractive than a year ago. Our own assessment shows a simple buy-on-dip strategy has worked well in recent decades, while another study noted that 3 to 12-month gains were usually strong after a 6% or greater weekly return. The main caveat, of course, is that these conclusions hold in non-recessionary years. Therefore, as we illustrate in more detail in the perspective section, it may be helpful to think in terms of scenarios. Our base case scenario continues to assume no US recession within the next 6 to 12 months, as US inflation eases in H2, enabling the Fed to turn its focus from fighting inflation to supporting growth. The lack of any new warning signals on our recession checklist and easing market inflation expectations in recent weeks support our base scenario. The main risk scenario, in our view, is one where inflation fails to peak as quickly as we expect, and the market inflation expectations return to or exceed recent highs. Besides continued supply disruptions, a further jump in oil prices is one way such a scenario could pan out. In this scenario, the Fed will be encouraged to over-tighten, even if growth weakens. Nevertheless, we believe a data-driven Fed is likely to reverse course on signs the economy is weakening sharply. Focus on the rebound. Regardless of the ultimate scenario, a near-term extension of the current equity rebound is likely. History shows buying the dip when 12-month returns turn negative was a strategy that delivered attractive benchmark-beating returns over time. Even under a recessionary bear market scenario, history shows us that the bear market rallies can be sizable. Within this bigger picture, there are 3 additional steps investors can take to diversify their risk while gauging recession risk. First, by continuing to hold gold, which we view as a preferred asset alongside equities. Second, through equity sector exposure. On a 6 to 12-month horizon, we continue to prefer the energy and financial sectors globally, healthcare sector in the US and Europe, and industrial sector in China. We expect these sectors to be the most likely beneficiaries of our base case macro environment. China offers diversification. A third way to diversify risk is through a varied regional allocation. Our scenarios offer a very US-centric view of the world, While this remains key for most major financial markets, China's economy and policy are at a different point in the economic cycle. This offers a way to diversify exposure from US-centric point scenarios. China's weak economic data is well known and arguably well priced, given the deep discount of Asian equities relative to global stocks and the large yield premiums on Asia USD bonds. However, China's gradual easing of tight COVID-19 restrictions and a noticeably greater policy emphasis on supporting economic growth are two positive catalysts that could not support Asian equities from here. The income opportunity. This equity market debate notwithstanding, one opportunity is that relatively less debate is today's increasingly attractive income yields. Our multi-asset income strategy now offers a yield of 5.6%, considerably higher than the sub 4% on offer for much of 2021 and not far from the 2020 sell-off peak. Allocations to income strategy today benefit from both wider yield premiums and higher government bond yields. This strategy also offers a way to gain exposure to our preferred bonds, developed market high yield bonds, Asia USD bonds, and emerging market USD government bonds. But within a well-diversified strategy that also incorporates high dividend-paying equities and non-core income assets such as REITs. Has the USD peaked? Recent narratives have increasingly questioned whether the ECB and other major central banks have room to catch up with the Fed. This raises the question of whether the USD has peaked. We continue to expect the USD to weaken over the next 6 to 12 months. We favour the commodity currencies as one way to gain exposure, especially as their central banks continue to hike rates, offering a buffer against any short-term retest of recent peaks in the USD or US government bond yields. Perspectives on key client questions. Inflation, the big picture. Global bonds and equities have witnessed one of the sharpest sell-offs in recent years, falling 12.7% and 12.3% respectively YTD. A key driver of this weakness has been persistently high inflation, which triggered concerns that the Fed could over-tighten policy, causing slowing growth or even recession. While inflation remains elevated, market volatility notwithstanding, the question on many investors' minds continues to be about whether they should hedge against inflation. There are signs that the worst of inflation may be behind us, with the latest US headline CPI moderating to 8.3% in April from 8.5% in March, and inflation expectations having eased significantly. In our base case, we expect US inflation to peak in H1 2022 before falling gradually to 5% by year end. However, there are several risks to our base case. First is higher oil and gas prices due to the return of Chinese oil demand after COVID-19 lockdowns end, and as a result of the EU's recent partial ban on Russian oil imports. Second, higher wages and rental costs in the US may be sticky, sustaining recent rises. Third, China's COVID-19 restrictions could exacerbate supply chain disruptions. If any of these risks play out, it could mean inflation does not moderate quite as fast as we expect. In a pessimistic scenario, inflation could make new highs. Here, we explore possible asset classes that we believe could help hedge against such an outcome. Very high inflation regimes are positive for real assets and commodities. We segmented US CPI inflation into different regimes and focused partially on the very high inflationary periods. Under this scenario, commodities were a standout performer, but private real estate, global REITs, and gold also delivered some of the best returns. Real assets, such as global REITs, tend to capture the upside from inflation through greater income growth due to higher rents. Equities were the clear underperformers in these high inflation regimes, particularly developed market equities, delivering negative returns across the board. This comes as increased borrowing and labour costs eat into their profit margins, weighing on the bottom line. Bonds, counterintuitively, performed well, delivering positive returns. This is likely due to a high starting point in yields. Historically, when inflation was very high, developed market government bonds outperformed due to their safe haven nature, as investors were likely to rotate into the asset class, while anticipating an economic downturn stemming from tighter financial conditions and inflationary pressures. How to position a portfolio if inflation remains elevated against the current economic backdrop? The following strategies can help offer a hedge against scenarios where inflation remains elevated or ticks higher. Have exposure to gold, private real assets, global REITs and commodities. In our view, this is an important step towards getting an investment allocation inflation ready. History shows these assets consistently outperform during high inflation scenarios. Consider increasing exposure to qualified government bonds. We maintain a neutral maturity profile stance, given upside risks to inflation. That said, higher rates tend to slow economic growth, and long tenure bonds can start looking more attractive, especially if growth slows or the economy enters a recession. At today's somewhat higher levels of bond yields, some exposure to high-quality bonds may provide a good portfolio hedge against recession risk. Bonds with floating rate characteristics can also help, diversifying equity exposure. Global infrastructure and natural resource equities performed well alongside commodities this year. These assets have historically delivered positive returns under high inflation regimes, albeit up to a point until inflation reaches very high levels, causing all equities to fall sharply. Therefore, assets such as private real estate, commodities, and gold can help hedge against any adverse scenarios of still high or rising inflation. While the performance of some of these hedges could turn lower under more optimistic scenarios where inflation falls more quickly than we expect, these assets should nevertheless enable investors to build diversified allocations prepared for a range of scenarios. Our thematic ideas. We provide a brief overview of our currently open thematic ideas, coupled with some recent highlights below. Embracing a digital future, technology stocks, especially our cybersecurity theme, continue to face pressure from rising bond yields. The impact can also be seen where earning revisions have turned down sharply, with consensus's expectations for both Internet of Things and cybersecurity-related earnings turning negative. While performance had been extremely challenged for cybersecurity, our IoT sub-theme performed in line with global equities since the start of May till date. We remain cautious in the near term, given that certain communications-related companies have missed earnings expectations due to pressures from rising inflation and interest rates. Nonetheless, from a longer-term perspective, a study by Grandview Research Inc. still provides a positive outlook. Global 5G infrastructure is estimated to reach a market size of $96 billion by 2030, with a compound annual growth rate of 34.2% from 2022 to 2030. With proper infrastructure in place, future development costs for 5G service providers are likely to decline, even as demand for their services rise. Therefore, we still see potential for the theme to deliver positive returns over the next 3 to 5 years. The winds of climate change. The performance of climate-related themes has been weak, with water and electric vehicles declining by 17% since the start of 2022. Valuations across the board have trended up this month, and earning revisions have deteriorated, with the most sub-themes seeing only marginally positive revisions. However, all our sub-themes have outperformed global equities since the start of May against the backdrop of improving overall investor sentiment in recent weeks. We believe this rebound is also attributed to potential oil supply constraints that is leading to a renewed focus on alternative energy. Moreover, EU's leaders' decision to partially ban Russian oil imports highlights the urgent need for alternative sources of energy to be made readily available. While we acknowledge that geopolitics remain a near-term headwind, we believe the outlook for renewable energy sources remains positive, given that European countries are likely to double down on efforts to become energy independent to hedge against oil supply disruptions. Thus, we retain our conviction in this theme over a 3 to 5 year horizon. China's common prosperity. 2022 continues to be a challenging year for Chinese equities, and our China-related themes to continue to see losses of over 20% YTD. Valuations have become slightly more expensive for our high-tech manufacturing and renewables sub-themes, which are trading at a 12-month forward PE of 22.5 times and 16 times respectively. To mitigate the impact of soaring energy prices and geopolitical instability caused by the Russian-Ukraine war, China has announced plans for 169 new and expanded coal projects that would potentially reduce the country's chances of meeting short-term climate targets. However, China has also recently tripled its investments in solar power projects, amounting to USD 4.3 billion in the first 4 months. This puts the nation on track to install record amounts of new clean energy capacity. Although China remains reliant on coal in the interim, we view these parallel efforts to develop renewable energy capacity as a strong commitment toward meeting China's net zero goals. While the near-term outlook appears to be challenged due to seemingly conflicting decisions, we believe that the strong political willpower will tide the country through, in the long term, in achieving both its economic and environmental targets.